In the last month alone, China sold nearly $10 billion worth of US Treasury bonds. That doesn't sound dramatic until you realize it's part of a much bigger pattern. China has now reduced its US debt holdings for 9 straight months, bringing total holdings down to roughly $759 billion. That's the lowest level since 2009, the same year the global financial system nearly collapsed. So the question isn't did China sell some bonds? The real question is why is China slowly walking away from US debt, and what does that mean for your money? So why China matters? So China isn't just another investor, they are the second largest foreign holder of US treasuries, America's largest manufacturing rival and a central player in global trade. For decades the relationship worked like this. China exported goods, earned dollars, recycled those dollars into US government debt. That system kept US borrowing cost low, the dollar dominant and global trade stable. But that system is changing and China's treasury holding peaked around $1.3 trillion in 2013. Since then they have been slowly but consistently reducing exposure, and 2024-2025 marked a clear acceleration. So why this timing is critical? So here's the part most people miss. In 2025 alone, the US government must refinance over $8 trillion in maturing debt, issue $2 trillion plus in new debt to fund deficits. That means the US Treasury needs around $10 trillion in buyer. At the same time, China is reducing purchases, Japan is defending its currency, domestic buyers are already stretched. When a major buyer steps back, yields must rise to attract new ones. And higher yields don't just affect Wall Street, they impact mortgage rates, auto loans, credit cards, and business investment. In other words, bond market shape everyday life. So where the money is going, China isn't selling treasuries to sit on cash, they are diversifying. One asset stands out above all others, that is gold. After pausing gold purchases earlier in 2024, China's central bank officially resumed buying. 5 tons reported in late 2024, additional purchases in early 2025. But here's the key detail. Most analysts believe official numbers understate reality. Gold can be accumulated through state banks, sovereign wealth channels, off-balance sheet reserves, and this isn't unique to China. Global central banks have been net buyers of gold for 15 straight years, with over 1,000 purchased annually, more than double historical averages. That's not risk speculation, that's risk management. And de-dollarization is no longer theory. This isn't just about gold, it's about reducing reliance on the dollar. Examples: China and Russia settling trade in local currencies, India buying energy in rupees, and Brazil and China expanding currency swap agreements. China's cross-border interbank payment system is alternative to SWIFT, processed over $24 trillion in transactions in 2024, up sharply year over year. Meanwhile, Asian companies are increasingly issuing debt in euros and local currencies bypassing the dollar entirely. So this doesn't mean the dollar is collapsing, it means its exclusive dominance is eroding, and reserve currencies don't disappear overnight, they fade gradually. Gold versus paper market. One of the most interesting signals right now isn't price, it's physical market stress. We have seen tightness in silver inventories, elevated lease rates in London, strong demand through Asian exchanges. When physical demand diverges from paper pricing, it usually signals supply chain strain, strategic stockpiling, or both. So this doesn't guarantee explosive prices tomorrow, but it does tell us institutional behavior is shifting and gold isn't being treated as a trade, it's being treated as insurance. So what history tells us? We have seen this movie before. In the early 1970s. The US ran persistent deficits. Foreign government cushioned dollar convertibility. Gold reserves drained. In 1971, the gold window closed and Bretton Woods ended. The difference today, back then there was no alternative system. Today, China is the world's largest exporter, a top trade partner for most countries, building parallel financial infrastructure. That doesn't mean a sudden collapse, it means multipolar money. So what should you actually take away from all this? So China selling treasuries isn't an attack, it's risk diversification. Rising yields reflect structural pressure, not panic. Gold buying signals long-term uncertainty, not short-term fear. The dollar remains dominant but no longer uncontested. This is how global systems change, not with headlines, not with crashes, but with quiet reallocations. And the investors who pay attention early don't panic, they prepare.